Welcome back to the Sense of Security podcast. I'm Cassidy Clement, Senior Manager of SEO and Content at Interactive Brokers, and today I'm your host for the podcast. Our guest is Sam Taube, investing spokesperson and writer at NerdWallet. Tax refunds can be a nice reprieve after going through the tedious task of doing your taxes every year. If you have a refund, how exactly can you make the most of that? And what are some financially strategic moves that you can make? Welcome to the program, Sam.
Thanks for having me on.
Yeah, so since it's your first episode, why don't you tell our listeners a little bit about your background in the industry?
So I have been a financial journalist for most of the last decade. I'm currently the lead investing writer and spokesperson for NerdWallet, and I also write our email newsletter, The Nerdy Investor.
Awesome. So when we're talking about today's magic topic of tax refunds, most people, at least when we're recording this, have met tax deadline yesterday, April 15th, the magic day, right?
Hopefully.
Yeah, hopefully. There's a lot of things that go into that, hope and prayers and dreams that maybe you get a refund or that at least you were budgeting the right amount. But most people are familiar with the phrasing, okay, tax season or tax refund. But when it comes down to it, does it usually range on how you file and how much you make, or is it more predictable for most?
There are a lot of variables that affect the size of your refund or the size of your bill. One of the biggest is just the nature of your income. Salaried employees, people who are W-2 workers, generally have income taxes automatically withheld from their paychecks, as do people receiving unemployment payments. In many of those cases, just filing your taxes is often enough to entitle you to a refund. It's different if you're a small business owner or a 1099 worker, like an independent contractor. Those people don't necessarily get automatic withholding, and they often need to pay estimated taxes quarterly in order to be eligible for a refund at tax time. If they don't, they often end up with a really big bill. And then retirees can go either way. Retirees who are withdrawing from a traditional 401k or IRA, or those who have not opted for taxes to be withheld from their Social Security checks, they're generally in the bucket where they need to pay in advance if they want to get a refund at tax time.
There's a lot of elements there that you mentioned. Are there some other things that maybe were more along the lines of like some credits or deductions? I know you mentioned a lot about status.
Certainly, deductions also play a really big role. Now, most taxpayers don't have enough itemizable deductions to make itemizing worthwhile, which means that they're generally best off taking the standard deduction. But the standard deduction varies in size based on your filing status, single versus married filing jointly versus head of household, etc. So that is another major variable that affects the size of your refund or bill.
So when we're going to utilize tax refunds, most people are going to say it depends on the size, right? But let's say you get a substantial one. Maybe it's your first year out of school and you got a full-time job, which was maybe a very different level of full-time income compared to maybe a part-time job during schooling. What are some ways that you can utilize a tax refund to move towards more positive financial goals? Maybe it's retirement funds or paying off loans, things of that nature.
Before I answer that, I should just say that I'm not speaking as a financial advisor here. And if you're unsure about the best way to utilize something like a tax refund, talking to a financial advisor can be one place to start. And if you don't have one, there are a number of kind of online shopping tools, and NerdWallet is one of them that can help you get connected with a financial advisor. Now, having gotten that little disclaimer out of the way, at the moment, a lot of people are looking for ways to increase the resiliency of their personal finances amid the uncertainty we've been going through the last couple months. Advisors say that two of the most important things you can do to prepare for a period of economic volatility or a potential recession are to build up an emergency fund with 3 to 6 months of living expenses, and also to pay down high interest debts such as credit cards. We're talking about debts here whose APR is much higher than you'd reasonably be able to earn in the stock market under normal circumstances. Those are definitely two things that I think a lot of people are thinking about right now as we watch the stock market whipsaw and we wonder what's next for the economy.
Yeah, the 3 words that stand out to me there are the resiliency, uncertainty, and volatility. It's like in the times of uncertainty and volatility, people would like to see some type of retention within their money or their cash flow that shows a resiliency over time, especially when you're just starting out or you're looking to have a larger purchase. But let's say that you decide, okay, I would like to incorporate some of this refund into a financial strategy? What are some things to keep in mind? Initially, you might think you're never guaranteed to get back what you put in or even more. You may lose it all. But what are some other things to keep in mind?
I think when it comes to the idea of investing a refund, one thing to keep in mind is that the timing of refunds isn't always perfectly predictable. On a similar note, if you're planning to invest your refund, it's worth keeping in mind that it would likely be a lump sum investment, which is a little different than the small recurring contributions a lot of people make to their retirement accounts. Now, this isn't a good or bad thing necessarily. Investing a large lump sum can be quite profitable if you happen to do it at the bottom of a bear market or in the early stages of a bull market, but it's almost impossible to identify those things in advance. If the market takes a turn for the worse after you invest a lump sum, that can hurt. But one way to mitigate that risk is to initially put your refund in just a savings or checking account and transfer small recurring amounts of it into your investments over time. That kind of allows you to take advantage of the same kind of dollar cost averaging effect that people get when they contribute to a 401k with their paycheck.
Yeah, and I think a lot of people will, you were talking about whipsaws earlier, start to look at their refund and say, wait a second, maybe I should really take a beat and think about where I'm going to put this now because we've seen some pretty high volatility. When we're actually settling down a little bit, if that's even possible, if that does happen, no one knows the future. But when the year moves on and we start to see or get an idea of the income that we're going to make or the potential income that may be on the horizon, what are some things to keep in mind for the upcoming tax year that may potentially yield a higher tax refund? There's many different things that come into consideration, like deductions and status and what goes towards retirement or HSAs or timing for your mortgage. What are some things that people should keep in mind from more of the expert perspective and research that you found?
As you mentioned, 401ks, IRAs, and health savings accounts, tax advantaged investment accounts of various kinds, are a great way to reduce your bill for the upcoming tax year. And it's worth mentioning, we're a little too late for this for the 2024 tax year, but you actually have until tax day to make contributions to those sorts of accounts. So, for example, if it's the end of 2025 and you're looking for ways to reduce your tax bill come April, you can generally still make contributions to those sorts of accounts until tax day in April 2026. So those sorts of accounts, because they allow contributions to be deducted from your taxes, can definitely be a good resource. If you're investing in a taxable brokerage account, it might be worth learning a bit about tax loss harvesting. This is a technique where some investors will strategically sell investments that have a negative return so that they can claim those losses and use them to cancel out taxable capital gains. You can do this with up to $3,000 worth of losses per year. And if you have more losses than that, you can carry them over to cancel out gains in future years. And finally, another thing that might be worth considering to folks who have a lot of money in taxable brokerage accounts and are wondering how to reduce their tax liability is looking into some tax-exempt fixed income investments. In the most recent issue of NerdWallet's investing newsletter, we gave an overview of some tax-exempt bond investments like municipal bonds and municipal bond funds that promise federal and sometimes also state and AMT tax exemptions. There are a number of options out there that can allow you to earn a return in a way that is not taxable.
You mentioned tax loss harvesting, which was great. We actually have an upcoming podcast on that. And you're right, it's definitely intricate and it does take a very keen eye to know if the situation is right for yourself. But one other part that I wanted to ask you about before we wrap up is the element of like new credits or new tax credits that may apply to new elements of your life. Are there certain things that come to mind for you or that you think about or write about that people may not initially think of? I guess a quick one that comes to mind is dependence. Sometimes people forget about that in the sense of maybe they had a major life change or maybe they had an income change within the year.
Dependents are a pretty big tax break for many people, and making sure that you have your paperwork in order to properly claim any dependent related credits that you're entitled to, that's another thing that is worth talking to a financial advisor about if you're not sure how to get those things in order. Another tax credit that I think is worth mentioning, we talked earlier about how small business owners and independent contractors often have a very different tax situation than salaried employees. Another tax credit worth considering if you're in that situation is the tax credit for obtaining health insurance coverage through a health insurance marketplace. I believe the form for that is called 1095C. And I can personally say from years when I've worked as a freelance journalist, that one can make a really big difference to make sure that all that information is entered correctly in your tax return.
Yeah, there's definitely a lot of elements that are associated to what you do for a living, how you file, how many people are in your household, if you want to call it that. I remember in the years I was in school and college, getting a form for my tuition that I would reference on my taxes that would help, I hope, offset some things when it came to what I would owe. But you brought up some awesome points today, Sam. Thanks for joining us.
Of course, thanks for having me on.
Sure. So, as always, listeners can learn more about an array of financial topics for free at interactivebrokers.com/campus. Follow us on your favorite podcast network and feel free to leave us a rating or review. Thanks for listening, everyone.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Interactive Brokers does not provide tax advice, does not make representations regarding the particular tax consequences of any investments, and cannot assist clients with tax filings. Investors should consult with their tax professional about the tax implications of any investment.